Imagine a bank, but not just any bank. This one is woven into the very fabric of your neighborhood. It's where your parents opened your first savings account, where you've got the loan for your first home, and where the local baker finances her new oven. This wasn't a fantasy. This was the American Savings and Loan Association. For decades, these institutions, known as S&Ls or thrifts, were the quiet, reliable engines of the American dream. Their business model was beautifully simple. They took in deposits from local families and lent that money back out as long-term fixed-rate mortgages. It was a closed loop of community finance, fueling the post-war suburban boom. Thrifts were conservative, predictable, and above all, safe. But their safety came at a price. They operated within a kind of golden cage. By law, they were forbidden from making risky investments. More importantly, they were limited by what's known as Regulation Q, which capped the interest rates they could pay to their depositors. This kept their costs low and stable, allowing them to offer those affordable 30-year mortgages. For a long time, this system worked perfectly. It was the bedrock of American home ownership, a symbol of financial security. But in the late 1970s, the economic ground began to shake, and a deep, structural crack appeared in this bedrock. The villain of our story, or perhaps its unwitting catalyst, was inflation. By the end of the 70s, it was out of control, a raging economic fire. To fight it, Federal Reserve Chairman Paul Volcker did something drastic. He jacked up interest rates to unprecedented levels, touching nearly 20%. For the thrifts, this was a death sentence. Suddenly, money market funds, which weren't bound by the same rules, were offering savers a juicy 15% return on their cash. Why would anyone keep their money in an S&L earning a legally capped 5.5%? They wouldn't, and they didn't. A mass exodus began. Savers pulled their money out of thrifts by the billions, a process called disintermediation. The thrifts were bleeding cash. They were now trapped in a financial nightmare. Their entire portfolio consisted of old, low-yielding mortgages paying them a mere 5 or 6%. But to attract any new deposits at all, they had to pay interest rates close to the sky-high market rate. They were earning pennies while paying out dollars. The math was brutal and inescapable. The S&L industry was dying a slow structural death, hemorrhaging money with every passing day. The very system designed to protect them was now strangling them. Desperate, the S&L industry turned to Washington for a lifeline. They pleaded for help, for a way to fix this fatal structural flaw. And Washington answered, but instead of a fire hose, they brought a can of gasoline. The solution, pushed by powerful lobbyists and politicians, wasn't to fix the problem. It was to unleash the thrifts. The idea was that if S&Ls could just make more money through riskier investments, they could earn their way out of the crisis. In 1980, and then more significantly in 1982, Congress passed a pair of laws that would change American finance forever. The most infamous was the Garnes-T.I. Germain Depository Institutions Act. This act wasn't a reform, it was a revolution. It tore down the walls of that golden cage, completely deregulating the S&L industry. Suddenly, these once sleepy community banks were allowed to dive headfirst into the riskiest corners of the financial world. They could make speculative commercial real estate loans, invest in junk bonds, finance corporate takeovers, and pour money into just about any high-risk venture they could find. And here's the crucial, catastrophic twist. While the thrifts were now free to gamble like Las Vegas high rollers, their deposits remained 100% insured by the federal government through an agency called the FSLIC, the Federal Savings and Loan Insurance Corporation. Think about the incentives this created. It was a one-way bet, with the U.S. taxpayer on the hook for all the losses. S&L owners, who were once modest community bankers, were now handed a golden ticket. They could take massive risks with depositor money. If those risky bets paid off, they and their shareholders would get fabulously wealthy. If the bets went bad, and they often did, it didn't matter. The FSLIC, backed by the full faith and credit of the United States Treasury, would step in and make all the depositors whole. There was no downside for the risk takers. It was a heads-I win, tails-you-lose proposition, with you being the American taxpayer. This wasn't just a policy mistake. It was a structural invitation for fraud and abuse on an epic scale. The floodgates opened. A new breed of aggressive, often corrupt, operators took over S&Ls across the country, particularly in states like Texas and California that had their own loose banking laws. They used federally insured deposits to fund a speculative frenzy. Money was thrown at empty office buildings in the desert, fleets of corporate jets, lavish parties, and risky acquisitions. One S&L owner, Charles Keating of Lincoln Savings and Loan, became the poster child for the crisis. He used depositor funds as his personal piggy bank, paying himself and his family millions, buying politicians, and making wildly speculative investments that eventually imploded. Honest S&L managers were forced to compete with these high flyers or go out of business. This wasn't just a few bad apples. The whole barrel was rotten. The system encouraged recklessness. Why make a safe 6% mortgage when you could finance a speculative shopping mall and potentially make 20%? If the mall went bust, who cares? The government would pay for it. This moral hazard, as economists call it, turned the S&L industry into a ticking time bomb. The losses began to mount, hidden at first by accounting tricks and lenient regulators who were often in the pockets of the very people they were supposed to be watching. The FSLIC, the insurance fund, was quickly being drained, but nobody in power wanted to admit how bad the problem was. By the late 1980s, the bomb finally went off. Hundreds of S&Ls failed, taking with them the life savings of communities. The FSLIC, the insurance fund meant to protect depositors, was completely insolvent. It didn't have a fraction of the money needed to cover the losses. The government had no choice but to step in. The final bill for the bailout was staggering, estimated at around $160 billion at the time, with some estimates putting the total economic cost much, much higher. To put that in perspective, that was more than the cost of the Marshall Plan and the Korean War combined, and over 75% of that bill was paid for by the American taxpayer. The S&L crisis was more than just a financial disaster. It was a government-sponsored heist, a story of deregulation gone mad, of greed, and of catastrophic political failure. It shattered the public's trust in financial institutions and their regulators. It showed how a perverse incentive structure combining deregulation with government guarantees can create a perfect storm for fraud and collapse. It was a painful lesson in how a system designed to build the American dream could be twisted into a machine for destroying it. The echoes of this crisis can still be heard today, a stark warning about the dangers of unchecked financial speculation and the high price of looking the other way. Thanks so much for watching. If you found this interesting, please like and subscribe for more deep dives into history. Imagine a quiet neighborhood bank, the kind of place your parents might have gone to for a mortgage. Now, picture that same bank morphing overnight into a high-stakes Vegas-style casino, playing with your money. That's exactly what happened in America during the 1980s, sparking one of the most outrageous financial scandals in the nation's history, the savings and loan crisis. It all started with a simple idea: deregulation. The government decided to loosen the rules on a sleepy corner of the banking world known as savings and loans, ORS&Ls. These institutions were traditionally conservative, focused on home mortgages for their local communities. But the new rules in the early 80s turned them into financial dynamite. Suddenly they could invest in almost anything, from risky real estate developments to junk bonds. It was like giving a teenager the keys to a Ferrari and an unlimited credit card. This change spawned a new breed of financier, the cowboy bankers. These were slick, charismatic, and utterly reckless individuals who saw the S&Ls not as a public trust, but as their personal piggy banks. And the most beautiful part for them, the deposits were federally insured. If their wild bets paid off, they got rich. If they failed, the American taxpayer would foot the bill. It was a no-lose proposition. From the sun-drenched landscapes of Texas, Arizona, and California, these cowboys built empires of greed. They used depositor money to finance lifestyles straight out of a movie. We're talking private jets, sprawling mansions, lavish parties, and fleets of luxury cars. They weren't just bankers. They were celebrities of excess, and they were funding it all with the savings of ordinary Americans. Their strategy was simple: grow at all costs. An S&L that was once a small, billion-dollar institution would explode to 10 times that size in just a few years, fueled by risky loans and speculative ventures. The fraud wasn't subtle or hidden in complex algorithms. It was brazen in your-face corruption. One of their favorite schemes was the land flip. Here's how it worked. A cowboy banker would have his S&L buy a piece of land from a buddy at a massively inflated price. Then, that same buddy would buy it back, only to sell it again to another S&L controlled by the same circle of friends, each time at an even higher price. On paper, these transactions created huge, instant profits. In reality, it was just a shell game, creating phantom wealth while funneling real cash into their pockets. Then there were the infamous air loans. Just as the name suggests, these were loans backed by nothing but thin air. A banker would approve a multi-million-dollar loan to a friend or business partner with no collateral, no credit check, no real business plan. The money was simply wired out, often with a hefty kickback for the banker who approved it. It was a system built on handshakes and backroom deals, completely detached from the principles of sound banking. At the heart of this web of deceit was Charles Keating, the poster boy for S&L corruption. His institution, Lincoln Savings and Loan, became a cesspool of fraudulent activity. When regulators started getting suspicious, Keating didn't just try to hide. He went on the offensive. He famously bribed 5 U.S. senators who would become known as the Keating Five to lean on the regulators and get them to back off. It was a shocking display of how money and political influence could be used to paralyze the very system meant to protect the public. So where were the watchdogs? Where were the regulators who were supposed to prevent this kind of chaos? The truth is, the regulatory system was designed to fail. The agencies responsible for overseeing the S&Ls were chronically understaffed and underfunded. An examiner earning $40,000 a year was expected to go up against armies of high-priced lawyers and accountants working for multi-billion-dollar institutions. It was a complete mismatch. Often these regulators were intimidated, When they tried to flag suspicious activity, they were met with political pressure from powerful congressmen, lobbied by the very bankers they were investigating. Many honest examiners who tried to sound the alarm found their careers stalled or were pushed out entirely. The entire ecosystem, from the bankers in their corner offices to the politicians on Capitol Hill, was perversely incentivized to let the party continue. The S&Ls had become the ultimate financial weapon for looting the public treasury. Like any wild party, this one had to end, and the hangover was brutal. The reckoning began in the mid-1980s when the commercial real estate market, particularly in the Sunbelt states where the cowboy bankers had run wild, collapsed. The oil price crash hit Texas hard, and suddenly, all those speculative office buildings, shopping malls, and condo projects they'd financed were worthless. They were ghost towns of glass and steel, monuments to greed. The S&Ls were left holding the bag. Their balance sheets were filled with billions of dollars in bad loans and junk bonds that were now worth pennies on the dollar. One by one, then by the dozen, they began to fail. The financial dominoes started to topple, and the scale of the disaster was becoming terrifyingly clear. The agency responsible for insuring all those deposits, the Federal Savings and Loan Insurance Corporation, or FSLIC, was the last line of defense. But by 1987, it was broke. The FSLIC was functionally insolvent. It had run out of cash to pay back depositors of the failed S&Ls. In a desperate attempt to hide the crisis, it started issuing IOUs promissory notes instead of actual money. It was a band-aid on a bullet wound. When the FSLIC finally collapsed, the true horror of the situation was laid bare for all to see. Of the roughly 3,000 savings and loans in the country, over 1,000 were insolvent. A third of the industry had been wiped out. The government could no longer pretend this was a minor problem or a few bad apples. The entire orchard was rotten. The crisis had become too big to hide, too big to manage, and too explosive to ignore. In 1989, a new administration and a stunned Congress were forced to act. They passed a landmark piece of legislation, the Financial Institutions Reform, Recovery and Enforcement Act, or FIREA. This act was essentially a surrender. It created a new government agency, the Resolution Trust Corporation, or RTC, with one grim mission: to take over the hundreds of failed S&Ls, liquidate their assets, and clean up the mess. The RTC's job was monumental. It became the largest seller of real estate in the world, auctioning off everything from half-finished skyscrapers and golf courses to private jets and fleets of repossessed cars. The government was admitting that a core part of the American banking system had suffered a catastrophic failure, and who was left to pay the bill for this decade-long crime spree? The American taxpayer. The final cost of the bailout soared to over $150 billion. It was a staggering price for a crisis born from a toxic mix of deregulation, greed, fraud, and political corruption. The S&L scandal stands as a stark and cautionary tale of what happens when oversight fails and greed runs unchecked. Have you ever heard of the savings and loan crisis? For most people, it's a forgotten chapter of financial history, a dusty old story from the 1980s. But what if I told you that this wasn't just some historical event? What if I told you it was the dress rehearsal for the 2008 financial meltdown, and that the same playbook is still being used today? The S&L crisis wasn't just a crisis. It was a blueprint for how to loot the American taxpayer. And it cost you, your parents, and possibly your grandparents a fortune. The final bill was staggering. We're talking over $160 billion in direct bailout funds. To put that in perspective, in today's money, that's nearly $400 billion. And where did this money come from? It wasn't from the bankers who made the reckless bets. It wasn't from the executives who cooked the books. No, it came directly from the pockets of ordinary Americans. It was a massive multi-generational transfer of wealth. Your tax dollars were used to cover the bad bets of a bunch of corrupt speculators. So how did we get here? It all started with a simple, noble idea: the savings and loan institution. For decades, S&Ls were the bedrock of American homeownership. They were local, community-focused banks that took in deposits from your neighbors and lent that money back out as mortgages for people in your town. They were boring, stable, and incredibly important. They operated under a set of strict rules known as the 3-6-3 rule: pay 3% interest on deposits, charge 6% interest on loans, and be on the golf course by 3 p.m. It was a simple, profitable, and low-risk business model. But in the late 1970s and early 80s, everything changed. A period of high inflation and high interest rates, known as stagflation, threw a wrench in the works. Suddenly, S&Ls were stuck paying high interest rates on deposits while they're old. Low-interest mortgages weren't bringing in enough money. They were bleeding cash. Instead of addressing the root problem, Washington came up with what they called a solution: deregulation. Politicians, lobbied heavily by the financial industry, argued that the old rules were holding S&Ls back. They needed to be unleashed to compete in the modern financial world. So, in the early 1980s, a series of laws were passed that blew the doors wide open. S&Ls were suddenly allowed to ditch their boring mortgage business and dive headfirst into the high-risk, high-reward world of commercial real estate, junk bonds, and all sorts of speculative ventures. At the same time, another crucial change was made. Federal deposit insurance, the guarantee that your savings was safe, was increased from $40,000 to $100,000 per account. Think about that combination for a second. You have a government guarantee on the downside and unlimited potential for profit on the upside. What could possibly go wrong? It was like giving the keys to a Lamborghini to a teenager and telling them the insurance will cover any crashes. An army of financial cowboys, con artists, and outright criminals descended on the S&L industry. They bought up sleepy local thrifts and turned them into personal piggy banks. Why lend money for a safe 30-year mortgage when you could finance a half-empty shopping mall in the middle of the desert? Or buy a portfolio of high-risk junk bonds? The money was flowing like water. These new S&L barons used depositor money insured by you, the taxpayer, to fund lavish lifestyles. We're talking private jets, yachts, mansions, and million-dollar parties. It was a frenzy of fraud and greed, all happening in plain sight. They were making incredibly risky bets, knowing that if the bets paid off, they'd get rich, and if the bets failed, well, the federal government, and by extension the American taxpayer, would pick up the tab. This is a classic case of what economists call moral hazard, but on a nationwide scale. For a few years, the party raged on. The economy seemed to be booming, real estate prices were soaring, and the architects of deregulation were patting themselves on the back. But it was all a mirage, built on a foundation of fraud and bad debt. By the late 1980s, the house of cards began to collapse, the speculative real estate projects went bust, the junk bond market crashed, hundreds of S&Ls across the country became insolvent, their assets worthless. The true cost of deregulation was finally coming into view, and it was horrifying. The government had to step in. They created a new agency, the Resolution Trust Corporation, or RTC, with a monumental task to clean up the mess. The RTC became one of the largest asset managers in the world overnight. Tasked with liquidating the assets of hundreds of failed S&Ls, they were selling off everything: office buildings, shopping malls, golf courses, corporate jets, even fine art collections bought with depositors' money. And this is where the story gets even more infuriating. The final price tag for the bailout, as I mentioned, was over $160 billion. This was a direct cost to taxpayers. But what about accountability? Surely, the people who caused this disaster, who committed widespread fraud, faced justice. Right, wrong. While the RTC did manage to clean up the assets, the legacy of the S&L crisis is one of profound and dangerous impunity. Despite thousands of criminal referrals, only a small fraction of the bankers and executives involved ever saw the inside of a jail cell, and the ones who did often received light sentences at so-called club-fed minimum security prisons. The real masterminds, the politicians and lobbyists who engineered the deregulation in the first place, walked away completely unscathed. They moved on to bigger and better things, leaving the American public to foot the bill. The most critical lesson from the S&L crisis is the one that was never learned. It proved a fatal formula for financial disaster. Combine deregulation with a government safety net like deposit insurance, and you create a perfect storm for systemic risk and massive fraud. It privatizes the profits and socializes the losses. The executives get to keep their bonuses and stock options when the gambles pay off. And when it all goes south, the taxpayers are left holding the bag. Sound familiar? It should be. S&L crisis was the dry run for the 2008 financial crisis. It established the dangerous precedent that some institutions are simply too big to fail. It created the exact blueprint for the massive housing and credit bubbles that would emerge 2 decades later. The only difference was the scale. The $160 billion S&L heist, as shocking as it was, would be dwarfed by the multi-trillion-dollar bailout that came in 2008. The same principles were at play: reckless speculation, lack of oversight, and the implicit promise that the government would be there to clean up the mess. The most dangerous moments in finance aren't just market crashes. They read the moments when the rules are quietly rewritten behind closed doors to reward recklessness and punish prudence. It's when the system is deliberately engineered to benefit a select few at the expense of everyone else. My parents always taught me that the best way to protect your future is to understand how the game is played. And in Washington, the only thing more dangerous than incompetence is organized corruption. The S&L crisis wasn't a mistake. It was a feature, not a bug, of a system designed to extract wealth from the public. If you want to understand how this system really works, how it's engineered to loot the taxpayer time and time again, and how to see the next crisis coming, make sure you hit that like button and subscribe to the channel. Thanks for watching.